On paper, the Chief Audit Executive is designed to be the ultimate corporate shield. The Institute of Internal Auditors envisions a fiercely independent watchdog tasked with securing a company against systemic risk. To maintain that strict independence, the auditor is required to report functionally straight to the top, directly to the Audit Committee. But in practice, this setup creates a massive structural blind spot, known as the reporting line paradox. While the functional line goes to the committee, the administrative line, day-to-day management, routes right through the chief financial officer. The CFO takes the blame for financial failures. Making them the boss of the team finding those failures is a massive conflict of interest. The reality of corporate governance is that whoever controls the administrative routing ultimately dictates the power dynamics of the entire audit function. Corporate governance codes usually require the Audit Committee to formally approve the appointment of the internal auditor, but this sign-off is frequently an illusion. The finance team manages the procurement and controls the shortlisting funnel. If a truly aggressive, independent firm applies, they are filtered out long before the proposals reach the board. The committee ends up picking their favorite from a pre-vetted list of CFO-friendly candidates. Once hired, the administrative levers are pulled. The CFO dictates the salary appraisals, the bonuses, the consulting fee increments, and the annual contract renewals. Human nature takes over. When an auditor discovers a massive controllership failure, they have to subconsciously calculate the personal financial risk of exposing the exact person who signs their paychecks. This direct control over an auditor's livelihood creates a level of financial pressure that consistently undermines the ability to remain objective. A savvy CFO rarely refuses an audit entirely. Instead, they apply pressure during the management response phase to manage the optics and protect their credibility in front of the board. The first tactic is downgrading the risk. They will aggressively push the auditor to change a high-risk finding to a medium or low-priority observation. Next comes sanitizing the language. By softening the words, a critical control failure is neatly packaged as an opportunity for process enhancement. Then there is the park it strategy. The CFO convinces the auditor to omit an issue from the committee presentation entirely, promising that a new software update will fix it internally by next quarter. Through these precise wordplays, threats are successfully neutralized. The board ends up reviewing a highly filtered, non-threatening version of financial reality. But the darkest and most effective form of CFO interference happens by design, through weaponized incompetence. Highly experienced CFOs know that seasoned auditors will see straight through their financial smoke and mirrors, so they intentionally avoid hiring them. Instead, they deliberately bring in inexperienced junior teams or consulting firms that rely heavily on unchecked fresh graduates. These inexperienced teams are kept incredibly busy. They spend their days counting petty cash and verifying stationery bills, permanently bogged down in low-level transactional checking. By monopolizing the auditor's bandwidth with trivial tasks, the CFO guarantees the team lacks the expertise to ever question complex treasury operations, revenue recognition policies, or related party transactions. Integrating the audit function into the CFO's administrative chain changes the priorities of the entire department. The audit team acts as a sub-function of the finance department's public relations strategy, prioritizing the appearance of safety over the detection of risk. The Audit Committee is lulled into a false sense of security, trusting that a highly capable watchdog is actively reviewing the books. But because of that illusion, massive systemic risks are allowed to grow quietly in the shadows, completely unexamined. It requires us to look closely at the structural integrity of our own corporate governance. If whoever holds the purse strings holds the power, is your internal audit function truly independent?